Welcome to the March 30th, 2020 Advance Report for McGowanGroup clients and NetWorthRadio.com listeners. This, an important broadcast from yours truly, your financial weatherman, a fast-paced tour of the raucous global financial markets. I'm Spencer McGowan, President, McGowan Group, and we'll get started with that fast-paced tour. But this broadcast could be one of the most important we've done so far, a special edition of YouTube McGowan Group. We'll start with the Dow Jones Industrial Average. What this tells you is near instantaneously, from Valentine's Day through Monday, a 40% reduction in the value of financial assets. And by the way, if you tried to sell your house, it's probably down that much if you could even get the deal done. Are you going to sell your house to prevent further losses? Probably not. What do we do from here? That's the focus of this broadcast. I want to be here with you, and I want to spend a little extra time on the concepts that we've been building here. Nobody got this perfect unless you're in cash. Yes, we were partial cash, but nobody had enough cash going into this. That's part of the lesson. And by the way, cash is going to have a negative yield going forward, according to the T-bill this week, which hit 0.11% minus, a charge for safety. Wow, that's a different financial market for investors. But investors look out 3 years, 5 years, 10 years, and yes, even to this time next year, which is going to be a much different picture, and I'll cover some of the ways to navigate that as we go forward. But that was a near 40% correction instantaneously, the fastest in history for U.S. equity. A 3-day rebound, a little setback on Friday. Where are we now with interest rates? This is critical. So the Fed says we'll just print as much money as we can. Oh my God, the low interest rate on the T-bill, we are looking at a 10 basis point minus, 11 basis points at the low this week. That means they take 1/10 of your money every year for sitting in 90-day T-bills. I'm not even sure where to go with that, but it also means your bank and your money markets a month from now or 2 months from now are going to have to charge you for staying in cash, and that's going to create a whole different picture for the markets. Now that you've built in, with that Dow I showed you, you've built in the worst case outcome for the current crisis. And as we go forward, the 30-year Treasury, 1.3%. What happens if that goes back to 2.3 where it was right there? Wow. And that was just at the beginning of the year. What happens? Well, that's called duration risk. It is going to cause havoc going forward once we come out of this for the interest rates to rise back up. Those treasuries have duration risk. Well, look at this. 0.74% on the 10-year Treasury. The low was 0.5%. Oh my gosh, what are we going to do with that? Well, first, we don't want duration risk. Cash is okay, but the yield is going to come in 0 or less in about a month. That's going to send a wall of money to certain parts of the market, and I believe we have some strategy based upon that, which we use to recover. I was sending emails to clients this week about how we recovered to record profits in 2009 from the 2008 crisis. But how we reached record income wasn't without price risk. Nobody's immune except cash at a time like this. That also means don't try to sell your house for a while, even if you wanted to. This time next year, you're going to have a much different picture, and they might be able to close the deal, and you might be able to find a buyer. But the disappearance of buyers because of the crisis is one of the key things to keep in mind. Perfectly good assets discounted 30 to 50%, and even those that pay income, especially like if you own rent houses or a commercial building where your renters have said we don't want to pay rent for a while. Will most businesses make it through? Part of the reason this happened, the Federal Reserve came to the table, opened up the checkbook and said, wait, This is unprecedented, will provide plenty of liquidity to prevent defaults and to prevent a depression. So that takes that off the table with as much capital as the markets are going to need. That was also needed globally. There was some selling from highly leveraged hedge funds, which I'll show you in a second what it did in 2008 and how we actually took advantage of it. All right, here's the crisis. Number of confirmed cases, right? Topping 500,000, on its way to 1 million based upon this graph. We covered some research earlier from China. This was a few weeks ago when we underestimated the crisis, and most people did underestimate the crisis except the medical community. Now we look at the cases here if we're going to released from the hospital. And that's rising, but not as fast as this, because testing was just rolled out, which explains why you're getting a barrage of bad news every single day as they rolled out testing. Well, as it turns out, there are lots and lots of people that have not even flu-like symptoms and recover. And that's becoming more common. Apparently there's an antibody. This is according to medical, not according to me. Well, let's look at some important graphs. This is China. This is the first graph we looked at. One of the graphs we showed a few weeks ago said it looks like it won't even reach 100,000 cases. That was before it spread to the rest of the world. That's what we missed in that report. But notice, China's 81,000 cases. What's this graph? That looks encouraging. These are the number of active cases in China. Now, what does that mean? It means that there's a peak point, and it happened just after Valentine's Day in China. What was that attributable to? Well, they had their isolation. Obviously, the Chinese are more capable of locking down everybody because they can put them in jail if they don't stay in their house. The United States, a little different. But what does that define? It defines a staged return to a new normal. Most of it is going to be defined in the month of April. So stay tuned and tune in often. But this is the key graph, the number of active cases in China. Why did it go down? And what caused it? We're going to learn a lot more over the next week. These are the number of new cases every single day, with that peak just before Valentine's Day in China. And where are we now? We're near 0 confirmed new cases each day. What happens to the rest of the world? Could it follow that graph? I think it does at some point, especially with the treatments that have been announced. How does it operate financially? Well, when we look at this, this is a basket of high-yield bonds. If you looked inside most banks out here and said, what's in their portfolio? It's generally A and B rated loans and bonds, and this is the price of those. Back there is par value. Par is 100, right? And this price graph shows you that the value of a basket of bonds has descended below 70 cents on the dollar. It got to 62 cents on the dollar. Par is 100, 62% is a nice discount, 38%. What was the default rate in the Depression? About 20%. What was the default rate in 2008 when the U.S. banking system was insolvent? It was about 10%. Perfectly good baskets of loans and bonds, which will have a higher default rate because of the crisis. Grant you that. Well, what does that mean? Well, you're already adjusted for a 2008. You're already below the 80 cents where you would price it in a depression, and you get interest every month. This is the short-term high-yield index. Let me show you what we used to help us recover from 2008 in less than 9 months. No guarantees that happens again, but again, everybody's taking price risk unless they were in cash. So let's go look at this. Here we have one of the best managers in the world. I've used this manager since 1992 successfully. And they've contributed greatly to our portfolio outcomes. The volatility is not unlike equity. There's 2008. There's the recovery in 2009. This powered us to record profits at about here. But we also had record income because we reinvested through the crisis. We used our cash reserves to add 12% interest, which we can do today in the high yield bond fund area at deep discounts to par value. If you buy a discount of over 30%, that puts you at 70. If it goes back close to par, you've got 20, 30% gain potential plus the yield to reinvest. And we enjoyed 5 years of superior income and gains. And what was the outcome? Well, if we look at the total return over this time period, that's through the crisis with that price detriment all the way to 2012. That's a 5-year period. It was a 24% price change and a 16% average return for this example. For the U.S. short-term high-yield index, it was a 12% average annual return. Do I want to take the risk of equity when the equity indexes aren't going back to their record peaks for quite a while because companies are detrimented? It took the equity indexes several years to get back to new highs, but if I'm getting paid to wait, that's a great strategy. And if I have a reliable basket of bonds that are well managed, I can compound my interest income, and I know that I control a basket of par value. And bonds tend to drift back to par once we sort out a crisis. And that was the lesson that I wanted to build in here for the rest of the year is get paid to wait, buy the best discounts, and by the way, baskets of good bonds are more reliable, but if they're at a huge premium like treasuries, that isn't going to work. Cash is not going to work, and be sure to tune to NetWorthRadio.com because we're going to go into much more detail than we have here at YouTube McGowan Group. Be sure to subscribe. We're going to be with you through the crisis, even after taking care of each and every client call and making sure that you get everything you need through the crisis of 2020. I'm Spencer McGowan. Thank you for joining us. Thank you for tuning in to our YouTube channel. I'm Spencer McGowan, President, McGowan Group, your financial weatherman. We sponsor each week NetWorthRadio.com broadcast that has the charts and graphs, many of which you saw today. We also sponsor this YouTube channel. Be sure to subscribe for fast breaking news, an alert when we post something in a market condition that may have changed. Our goal is to help you as an investor make the right decisions at the right time. And that's part of what this YouTube channel is about, as well as NetWorthRadio.com. I am well served with a team of 10 people, including myself. And that team that cares is actually made up of people who devoted to your net profits and your success, as well as excellence in service. If you want an educational experience to follow this up, get to NetWorthRadio.com, the McGowanGroup.com. Right here, we disclose our net client experience all the way back to 2001. What that includes, the bear market cycles of 02, 08, 2018, and the recoveries through the most recent quarter. That is true education of investors and exactly how our clients have done, disclosed right here. Further disclosures, value at risk of loss. Yes, investments are going to fluctuate. That's part of the reason for this broadcast. And that can actually work to your advantage. We'll build that into your plan. So I urge you to go to NetWorthRadio.com, fill out the preliminary client questionnaire, a free 1-hour brainstorming session by phone or at the Crescent in Dallas, and we will map out a multi-year plan for you and your family that's appropriate. Just because we talk about a security on this broadcast or any securities doesn't make it a recommendation for your portfolio until you have that written plan. thank you for tuning in today, and we'll be back next week as your financial weatherman.